Will be a matter of in the coming weeks, really what the market starts to expect out of the Fed at that September meeting. We might get a lot of those expectations being formed next week as we hear from Jay Powell, and a lot of other headlines I'm sure will come out of the Jackson Hole meeting. But I think the big difference here is, although we've seen this slowdown out of a lot of this economic activity, it hasn't really translated into some sort of an earnings type of a recession. So I think that's the big difference maker, is as long as earnings can be expected to tread water, maintain, or even eke out a decent amount of growth, that to me would be a good reason why the market is not necessarily responding to some of the data coming in, because it hasn't really shown up in earnings just yet to the extent that we're seeing it show up in maybe some of the overall economic data. But if that starts to evolve and you do get the sense that maybe we are going to get a significant impact to earnings moving forward, I think that would be maybe the catalyst for a significant flush out lower out of the markets.
Peter, things on the credit side have improved in the last couple of months in terms of, corporate credit spreads, things like that. That's been part of the financial condition loosening. And you would think the backdrop isn't that terrible for corporate credit, just in the sense of nominal growth is high, interest coverage looks okay, in aggregate anyway. Does that give you any sense that there's a cushion underneath equities for that reason, or is that a miscalculation?
Yeah, I think there are a couple of layers of that onion to peel back. And I think the first is for both equities and credit, and then I'll address your question very directly, is that the Fed risks a whipsaw here, not unlike 2019. It needs to be communicating a very tough stance on inflation. The risk of overstepping is great here. I think the economy is going to slow quickly, and I think inflation is going to turn very quickly in non-energy. And in fact, that's the tough part, because energy prices in Europe are going to pull the whole energy complex higher, while growth and demand actually begins to crack here in the U.S. As far as credit markets go, nearing 600 basis points for high yield credit in mid-June was implying something like a 6% forward, 1 year forward default rate. And, our view was that was just a little bit too far, too fast. That said, it is starting to show up in earnings and profits. Guidance for both large caps and small caps has actually been very poor, and interest coverage for the bottom quartile, especially in the high yield universe, is now very low and below 1 times. So I do think we're going to start to see default rates pick up, and I think we're going to see credit spreads widen into what I do believe, continue to believe, and have for some time will be a recession in late 2022, early 2023. And during that type of an economic environment, you see credit spreads for high yield corporates, approaching, 10%.
Yeah, and then we're nowhere near that right now. Neil, you wanted to sort of have some nuance in that inflation view?
I think the issue is that recession that he's talking about probably wouldn't be deep enough to increase the unemployment rate enough to turn inflation around that quickly. I mean, remember, inflation is a process, particularly outside of commodities. Mm-hmm. You look at housing inventory, it's pared to the bone. Prices are still running firm. If you're a landlord, are you going to start cutting rents with the underlying value of the asset going up? And that is an important story. So, and right now, what does the drop in gas prices mean? What does the drop in used car prices mean? That's effectively a tax cut given what's going on in the labor market. So people are doing what? They're taking those savings and spending it elsewhere, driving up the prices for those goods and services. You look at some of the weekly credit card data, Mike, It's running double digits. Companies don't need to be cutting prices that aggressively in that kind of a consumption environment. So I think the risk isn't so much that the economy is going to collapse. It's more of this sort of slow bleed, not slowing enough, meaning the Fed has to do more.
So that suggests what ultimately, in other words, is it just that incrementally the Fed is going to have to keep on the inflation case and the economy will slow enough, or they'll have to do some real damage to demand?
Exactly. I mean, the economy is not going into a recession on its own.
Right.
The Fed is basically telling you that's what is probably required in order to bring inflation down to 2%.
No, it's not right.
Sorry, Peter?
I was just going to say, I actually disagree with that because the economy can go into recession on its own. It's not just the Fed that can push an economy into recession, because we've never seen inflation like this since the 1970s. In fact, one of the reasons why the Fed fears inflation so much is because inflation is something that can really push economies into recession. And the Fed was extremely late here. So unfortunately, we're in a position now where both inflation is going to push us into the recession, as well as financial conditioning tightening. And I agree with you, Neil, 100%, that there's a lot of stickiness to inflation here and things like OER and rents. And in fact, that's actually one of the reasons at Axonic why we love multifamily so much and have all year, because affordability in the U.S. for housing is absolutely horrendous. And defensive cash flowing plays like multifamily and their related assets, make a heck of a lot of sense to us, especially relative to equity markets, which just to us are not the place to be right now.